So, part one, Anatomy of Finance, lecture one. The fundamental concept that we have to understand to start is the concept of money. So, our motivating question for today is, what is money? Now, the common answer, which I'll call definition 1.0 by Merriam-Webster, is that money is a commonly accepted excuse my spelling, commonly accepted medium of exchange. So it is the vehicle by which we use to exchange goods and services. That is the basic definition of money, the traditional definition of money. However, I actually don't like this definition because I think it's too restrictive and I think it doesn't actually get at what the core of money is. So to illustrate why I don't like it, let's just consider a simple question. For those of you listening, what is your net worth? What does it comprise of? Well, for those of you fortunate enough to not be in debt, let's just consider net worth. This might be, cash in your pocket. This might be a checkings account that has a number in it. Obviously, depending on who you are, the cash in your pocket is probably a smaller proportion of your net worth. Your checkings account is most likely a little larger. I should say at a bank. And then some of your net worth might be in even a CD, a certificate of deposit. Some of your money might be in stocks in your brokerage. Some of it might even be in bonds, in treasuries. And some of it might even be in what is commonly now called money market funds. And typically when people think of their net worth, they think of all of these things, their dollar value, and summed together. Of course, minus any debts that you might have. But for now, let's just think about assets. So I think the definition that Merriam-Webster gives is flawed because whenever people think of their own net worth, they actually think of a range of different things that sort of have value. And the definition of money seems to only include part of this list, but it's a part of this list that I think is an unnatural separation, right? So the definition 1.0 separates these things that I listed into money and not money. So cash, I think, by Merriam-Webster, is money, because obviously this is the most basic form of money. You go to the store, you buy something with cash. Your checkings account is also mostly considered money. You can use a debit card to buy something on Amazon, for example, or even to pay a store or a restaurant. That's money. But what about CDs? So CDs, for those of you who are not familiar, are essentially an account, but you can't withdraw from it early without incurring a penalty. So is that money? Well, in a pinch, you could use it. I think, I haven't done this myself, but I believe you can draw from it to pay someone, a vendor, but you incur a penalty. So is that commonly accepted? I'm not so sure. I think maybe, but I think this is a question mark. And then, of course, there's stocks. So stocks, you cannot generally go to the store and offer your share of SPY in exchange for a good. But of course, in some circumstances, you can actually do this. You can, if you're a founder, you own some stock, and you can actually use your claims. You can sell down your own claims of your own company for funding, right? But of course, this is a very uncommon case. So I think for this case, the answer would be no. And then there's bonds. Similar thing for stocks. Also generally not considered a medium of exchange for the average American, at the very least. And then there's money market funds, which is an interesting one because money market funds are actually closer to a checkings account, but it's a little more obfuscated. So I'm also going to put this one as a question mark. And I don't like the way that the definition 1.0 sort of artificially divides up all these things. So in my mind, all these things are sort of fundamentally similar. So I'm going to propose a new definition of money. Definition 1.1, my definition, which is money is a credible promise of something else. In its most general form, I think this is the better definition of money. And I think if you've heard this for the first time, depending on your background, this might seem really, really strange to you. But let me just let's give some examples. So cash, I think cash is sort of the most pure form of money, is a promise for future goods and services. Right? So the reason why a vendor might accept cash for, if he's a street vendor of fruits, he accepts cash for fruit. If you go to the masseuse, you give them the spa some cash. The reason why they accept that for payment is because they know that cash in the future can be used to be exchanged for goods and services they might need. So at first glance, this actually seems more like definition 1.0, a commonly accepted medium of exchange, which it is. It is a commonly accepted medium of exchange. But what's really happening, I would argue, is that vendors and generally people accept cash because what cash is it represents a promise for future goods and services. It's essentially a claim on the productive labor or the useful labor, the useful goods and services of people in the society at large. Now, what is a checkings account? A checkings account is a promise for cash. Formally, when you have a checkings account, let's say worth $10,000, what that formally means is that the bank, you have a claim of up to $10,000 on the bank for $10,000 of cash. Now, we live in a very aggressively banked society in America, at the very least. So even though you can think of this as a second tier form of money, right? The first tier form of money is the cash itself, which is a promise for future goods and services. The checkings account is a promise on top of the promise. But we live in such a banked society that everyone has checkings accounts, and the fact that it's a second tier promise is kind of forgotten, and we kind of only think of the checkings account as equivalent to cash, right? So we sort of operate, at least among the well-banked, operate as if money in the account is the same as money in the form of cash. Now, what is a stock? And what is a bond? So we'll go over these in a little more detail in a future lecture. But a stock is a promise of future revenues of a company. And more formally, it's, I guess you would legally call it a claim on future revenues of a company. Fundamentally, it's a financial contract that pays dividends. And not dissimilarly, but significantly differently, a bond is a promise on fixed future payments. Okay. Um, and we can go a little further. So an ETF is a promise on a basket of stocks. So already we can see the flexibility of definition 1.1. It's money is a very generally defined as a credible promise of something else. This something else can be anything. And because it can be anything, we often see in our financial system that we have products that are essentially second tier or third tier or even fourth tier promises, right? So a checkings account, right, is a promise for cash, which itself is a promise for future goods and services. An ETF is a promise on a basket of stocks. Each stock is a promise on the future revenues of a company. And of course, future revenues, them being themselves cash, is a promise for future goods and services. And as long as each of these layers is a credible promise, you can sort of stack them. And you can sort of make more and more exotic, let's say, promises. And as long as it's marketed correctly, as long as you get the SEC approval, as long as you convince everyone that your next tier is also credible, then it becomes, under my definition, 1.1, money. Okay, so I think that, if you kind of struggle to understand why money is fundamentally a promise, um, I think, one question you might ask is, don't you, like the traditional view is that you need to, okay. One natural question then is how to acquire money, let's say. And I think the traditional view is, let's call it traditional, is to acquire money, you have to provide goods and services. And don't get me wrong, I think this is very fair. This is a very reasonable view. I think ultimately, if no one, we all need, society at large needs to provide goods and services, and you can't expect something for nothing. And this is the sort of the classic story of a man or a woman, entrepreneurial individual who picks themselves up by the bootstraps by providing value for the community and selling that value essentially for money, and then saving a little piggy bank to buy something for themselves. And I think that is, definitely a way to make money, to create money. But I think the real answer, my answer, the second answer, let's call this the more radical answer, is to acquire money, to create money. All you need to do is to make a credible promise. That's all you really need to do. You don't actually need to create value first and then sell it. You actually just need to sort of, it's almost like a magic trick. As if you can convince someone that your promise is credible, then you have functionally created money. And this is very counterintuitive. You might, some people might even call this lazy. And I think maybe some people might even call this trickery. It's trickery. It's witchcraft even. I think that there's that's a way of looking at it. But to sort of prove my case, I'm going to give you two historical examples that kind of prove that the more radical answer to this question is actually correct. And so the first example is microcredit, and by a man of the name Muhammad Yunus, who is currently sitting as the Prime Minister of Bangladesh after the 2024 revolution. And basically what he did is he partnered with the bank and he provided loans to mainly like rural women. And what he found, and the backstory is that these women, very poor backgrounds, very poor villages, didn't have too much money to begin with, and sort of a more traditional bank would have never extended these loans. But what he did is he just said, you're going to, it is risky, but what we're going to do is we're going to give loans to all the women in a particular area. Just very small, maybe on the order of like $100 USD. Of course, that's quite a lot by standards of a rather poor country, but from the standards of a bank, a national bank on the scale of even a poor country like Bangladesh, it's not too much. And what he found is that after you do this, all the women will actually trade with each other using the loans they got, and in doing so, this actually jumpstarts the local economy, and it actually has this effect where it lifts people out of poverty. And all of these loans really are is that it's a credible promise by the bank to honor their checking account. So formally, all a loan is a bank opens an account under a particular woman's name, and that woman can go to the bank and get cash. But of course, if everyone has an account at the bank, and most of the women just trade with each other, or most of the people, let's say, that are provided this credit just trade with each other, then no one actually needs to go to the bank. They can just trade claims at the bank between each other. And in so doing, they essentially create there's a liquidity creation event. And all the women are able suddenly to buy the things they previously couldn't buy. And in doing so, they stimulate the productive behaviors and the businesses of all the women that provide those goods and services. And this essentially has the effect of jump-starting the economy. Jump-starts economy. And if you want to read more about this, it's all online. He won a Nobel Prize for this work. And this case, I think, points to evidence that the radical answer to the question is actually the correct one. All you need to do to create money is to create a credible promise of something else. In this case, bank reserves. So my second example is something that's a little less, virtuous, which is the MIFO bill. And basically, this is how Germany, just to be exact here, how Nazi Germany funded rearmament. Okay. So the important things here is that under World War I treaties, this is disallowed. Rearmament is disallowed. And basically the banks in Paris and London had the capacity to sort of monitor financial activities and basically notice whenever finances were flowing towards armament factories. But of course, the Nazis, being bent on war, wanted to build up their economies anyway. So they created a shell company called the MIFO that essentially issued bonds. The details here are, details basically, but basically these the company itself was fake, and it issued bonds on itself. Basically pieces of paper that said this company will pay you back, and this company had initially had some credibility because it was sort of the merger of several existing companies, but it actually didn't really exist. But in the time of the 1930s, where it was difficult to find out what was happening, it was not so clear that this company didn't exist. And this company had the backing of the central government. And what ended up happening was these bonds were essentially treated as currency and were used as the means of circulation between German industrial and military companies to basically fund their armament. So instead of trading Deutschmarks, they would trade these MIFO bills. And because they were MIFO bills, because they were constructed purely under a shell company that London and Paris didn't really have transparency on, they could essentially hide all the financial transactions between the industrial, chemical, and military industries of Germany. And this really did enable them to rearm. So I think both these examples sort of demonstrate, yes, it is, Merriam-Webster's definition 1.0, a commonly accepted medium of exchange, is definitely a true quality of money. But it's only a property of money. It's not the definition. The definition of money is a credible promise of something else. And the proof, I think, of this is these two historical examples where the creation of money is basically the creation of a promise that is widely believed. And once that promise is created and in the hands of a sort of a group of people or industries, they will then begin to use this promise as a means of circulation between all of them. And in that sense, it becomes more like definition 1.0. But to say that definition 1.0 is the true definition is to sort of is to miss the point. The true definition is really the creation of a credible promise. And that's sort of my view. And I think that it is the philosophically correct view, as it were. And, to end this lecture, I want to read some scripture that I thought was relevant. So this is Matthew 5:34-37. Quote, "Again, you have heard that it was said to the people long ago, 'Do not break your oath, but fulfill to the Lord the vows you have made.' But I tell you, do not swear an oath at all, either by heaven, for it is God's throne, or by the earth, for it is his footstool, or by Jerusalem, for it is the city of the great king. And do not swear by your head, for you cannot make even one hair white or black. All you need to say is simply yes or no. Anything beyond this comes from the evil one." Yeah, well, thanks for listening. We'll be back next time to discuss balance sheets. So, see you then.